We're good to go.
Thanks, Eric,
You're welcome.
appreciate it. And we're good on your end, Vanessa? Okay, thank you so much. Good morning, ladies and gentlemen, welcome. We will call to order the regular quarterly meeting of the Lawrence County Retirement Board. Today is Tuesday, November 14 of 2023. We ask if you have any type of electronic communication device, if you'd please put it on silent or vibrate. We would appreciate that courtesy. And we always begin with the Pledge of Allegiance, and if you remain standing, we'll have a moment of silence. Controller Presta Pine, would you lead us in the pledge, please?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Please remain standing. We'll have a moment of silence. Thank you. Vanessa, would you call the roll, please?
Controller Prestapine.
Here.
Treasurer Rapone.
Present.
Commissioner Steelvogel.
Here.
Commissioner Burek.
Present.
Commissioner Vogler.
Here. We have a quorum. All five members are in attendance. We always have opportunities for public comment, both at the beginning of the meeting and prior to the adjournment of the meeting. We would ask that if you do have comments, that they be related to the retirement board issues. And if you could try to limit your time to about 5 minutes, we'd appreciate that. You're welcome to comment both times, one of the two times, or if you're just here to listen, that's equally fine. So, that being said, are there any public comments at this
I
time?
have a little request, if you're gonna be renewing some paperwork in public, you have extra copies. Because sometimes I, like you're explaining.
We usually get an extra one. Can we?
Yeah, I did.
Give Debbie the, and I don't know if there were enough of these as well. But,
Thank you very much.
add to your stack, Debbie. It's starting to pile up over there. Thank you, Debbie.
Thank you.
Anything
I
else?
Appreciate it.
Certainly. Anything else?
No, thank you.
Okay. And again, we'll reopen it before we adjourn. If there are no other public comments, I'll call your attention to the minutes of the most recent meeting of this board, which took place on August 15 of 2023. Give you time to look it over, and whenever anyone would be ready, I can entertain a motion to adopt the minutes.
Also move.
Second. Mr. Burek moves and Treasurer Rapone offers the second to approve the minutes as submitted. Are there any concerns or questions? Hearing none, roll call, please.
Controller Prestapine.
Yes.
Treasurer Rapone.
Yes.
Commissioner Steelvogel.
Yes.
Commissioner Burek.
Yes.
Commissioner Vogler.
Yes.
Motion carries.
Thank you so much. I've been asked if we could reverse order in terms of presentations. So we'll drop down to Roman numeral 5, which is Mr. David Reichert from Corn Ferry. He's going to offer the actuarial review. Mr. Reichert, if you can have a seat there so the microphone can pick you up. And David, you've been with us before. It's a pleasure to have you back. But refresh my bad memory. Where do you make your home?
Philadelphia.
Are you in the city or out in one of the suburbs?
Our offices are in the city.
Okay.
I actually live in Westchester, so
You're in
it's a little
Chester,
bit closer.
Chester
Yes, I'm
County.
in Chester County. So
That's a nice part of the state.
I think a lot of the area in Pennsylvania is really nice. So yeah, there's a lot.
They make really good potato chips from down there. Hers.
Birds, yes.
Down off of
Very
Route
much
1.
So, yes.
Excellent. I've been to their factory.
Yeah.
And, I always stock up when I'm done.
That's a good idea
Yeah.
to stock up. They are very good, delicious.
Well, we welcome you, and I know you probably have a long either drive or plane ride home, so I'm assuming you probably want to get going.
So yes,
We
so I
understand.
will try to keep it short.
That's quite all right.
But yes, yeah.
So
It is
please,
something, good morning and thank you for having me. I appreciate the opportunity to discuss our work and the 2023 valuation report. The plan's in very good shape. When I say typically plans that are in good shape, they have three traits. First, they contribute 100% of the contribution or the ADC. And you've done that over the years, so that's good. The second trait that a lot of plans that are in good shape follow are that they maintain their liabilities. And what I mean by that is that they keep their assumptions updated and they don't give excess increases in their salaries or benefit levels, which you have done. And thirdly, the trait that, a lot of plans follow is that you invest well. And you've invested well over the years with the excellent support and guidance of Sarah and Marquette. So, those three traits is what we see on plans that, are in good shape, and you follow them over the years and, just continue to, do that, going forward. If you can turn, this presentation that I have is kind of a summary of the valuation report. The valuation report is about 40 pages. We've narrowed it down to about 15. But if you turn to page 6, it has the 4 primary risks associated with retirement plans. And those 4 risks are interrelated. They are the investment risk, contribution risk, liquidity risk, and longevity risk. What we're trying to do when we put the valuation together is to try to eliminate a lot of the risk associated with the retirement plan. So if we can go through these 4 risks, the investment risk is the risk that the assumed rate of return is not achieved. If we assume a high rate of return and you don't meet it, then each year your contribution is going to go up. And if your contribution goes up, that's when counties get in trouble or retirement plans get in trouble that they can't make the contribution. So we want to try to keep the contribution as consistent as possible. The next is the contribution risk. Contribution risk is the county does not pay the full ADC. We just talked about, if the investment return assumption is high, that's one way that, plans don't make their contribution. Another way of, when plans get in trouble is when there's a lot of fluctuation with the ADC or the county contribution.
Forgive my interruption. Can you tell us, for the record, ADC stands for?
Actuarially determined contribution. Okay? And that's the county's contribution. Okay? And where we see that is if there is a lot of fluctuation, and we may see that if there's, a couple of years where the contribution is 0 or very low, and then it jumps up to a very high number. And I'll get into some of the examples of that later on in the presentation. Okay. The next risk that I want to talk about is liquidity risk. That's the risk that investments cannot be liquidated timely to pay benefits. And we find that as a problem if you're trying to achieve a high rate of return, and you have to allocate some of your investments to make that high rate of return. It's also an issue with the contribution. If you don't have contribution going into the plan each year, like if you had a 0 contribution for 1 or 2 years, you don't have any money going in, and then you have to use some of your assets to liquidate and pay benefits. So what we try to do with valuation is make sure that you have some type of contribution so you have a cash flow going in to help pay some of the benefits each year. Okay? And then the last risk that we want to talk about is the longevity risk. That's the risk that plan participants live longer than expected, and therefore, it would cost the plan a little bit of money. You currently are using a very moderate or a current mortality table. It is based off of the public sector data. So it is the greatest and best mortality table out there. So that's why, all these risks we don't see really affecting your plans because you've done such a good job at managing all of these risks. So, once again, you've done an excellent job at maintaining your retirement plan. Okay. So then, if we turn to page 8, I want to talk about, keeping your contribution in, so it's not fluctuating as much. And one of the methods that we use to reduce the fluctuation as far as the county's contribution is by smoothing the assets. There are two purposes as far as smoothing assets. One is to dampen the volatility of the markets, and two, to reflect what is happening with your assets. Okay? And if you look at the chart on page 8, the green line represents the market value and the orange line represents the smooth assets. From 2018 to 2022, both the lines increase. But then in 2023, both lines decrease. So they do reflect what's happening to each other, but it's just that the orange line isn't as volatile as the green line. Now, what I want to do is concentrate on 2021, 2022, and 2023. You see, in 2021 and 2022, the market value of assets is larger than the smooth assets. Now, when we put the valuation report together and when we determine the county's contribution, we use the smooth assets. But if we were to use the market value, in 2021 and 2022, the county's contribution would have been 0. But in 2023, it would have jumped up to $1.3 million. So you see that big jump, and that goes back to that contribution risk that we want to try to avoid. So then with the smooth assets, in 2021, your contribution was about $300,000. 2022 is about $100,000, and now it's up to just under $500,000. So there's a lot less volatility, and that's what we're trying to do. One comment that we've heard with a lot of our county clients is, why did our ADC or our estimated ADC go up so much for 2024? Well, it's because your assets haven't recovered far enough yet to get back to that 2002 level. What we're seeing in most of the counties, I'm not sure with the latest asset figures, but what we're seeing is that they're still below that 2021 number. And when we calculated that estimate for 2024, I think we used around $88 million, which you can see is less than 2021 numbers. So, until those numbers do move up, we're still going to see probably an increase in the county's contribution. Okay, but we're going to try to smooth it as much as possible. Okay. Any questions as far as that's concerned? Then I want to look at pages 10 through 12. Those are the numbers that are kind of a summary of what's in the valuation report. On page 10 is a summary of the member information. We break the member information into 3 groups: the active participants, the annuitants and beneficiaries, and the inactives. The actives are your employees that are contributing to the plan currently. The annuitants and beneficiaries, those are the people that are actually receiving a monthly check or a monthly payment. And the inactives are those individuals that are terminated and are entitled to a future benefit but haven't started their benefit yet. Okay. Any questions? If you want me to go into more detail, I can, but those are the numbers. Over on page 11 is the calculation of the county contribution, or the ADC, for the last 2 years. These are really great numbers. As a percentage of payroll, this past year you were just under 3%. Last year you were under 1%. Great numbers. Funded ratio over 100% both years. Great numbers. Turning to page 12. Here's a 10-year history of the funded ratio. The last 6 or 7 years, you've been at or above 100%. Great numbers. And even before that, you were mostly in the 90s. You had that 1 year in 16, it was probably a bad year as far as the markets were concerned, but it was a little bit of a drop. But even 86% is a good number. Okay, so all great numbers as far as the valuation report is concerned. Any questions on any of those numbers? Last thing I want to really touch on is just more for information purposes, but on page 13, it's a chart of the investment return assumption. This chart represents a lot of the public sector retirement plans throughout the country. And I just want to apply it to your county. 20 years ago, the median investment return assumption was 8%. You were 20 years ago at 7.5%, so you were a little on the conservative side. Currently, the median is at 7%. You're at 6.75%, also on the conservative side. So once again, you're in really good shape, and you're not taking much risk in your retirement plan, which is good. So, all things considered, it's a really good job as far as the retirement board is concerned. And then lastly, page 15, over the next couple of months, we'll get ready for 2022 and just keep up the great work. Continue to do the good work that you've done, and hopefully it'll continue in the future. And thank you, and I'll open it up for any questions that you have.
David, first of all, thank you for presenting this and the manner in which you did, so that I figure if I understood it, everybody else certainly understood it. I take a lot of comfort in the fact that you used the word good throughout your presentation. I don't think I heard the word bad very often. And that brings me comfort. I'm sure it brings my colleagues comfort, and I think it should bring our retirees and our future retirees some comfort. And it's been a team effort between the work that our friend Sarah and her staff at Marquette have done as far as the investments, and the seriousness that's devoted to our roles as members of this board. We've all taken this role very seriously, but I'm very grateful that you've brought this news to us, and I think it's incumbent upon us to continue the policies and practices that we've already undertaken, and hopefully the good news will continue. So thank you so much. I'll start with Commissioner Spielvogel to see if she has any questions.
No questions. Thank you for the great explanation. Thank you.
Thank you, Loretta. Controller Prestopine.
I do not, it's all good news.
And I've always said, when my controller's happy,
Yes.
Treasurer Rapone.
No, David, I echo Dan's sentiments. And it brings me great peace of mind. It really does. So thank you. That was a great report.
Thank you, Rich. Commissioner Burek.
Just one question.
Always.
You mentioned the longevity risk. I'm just curious, did COVID have an impact on the mortality charts as far as I thought I read in the media that for the first time in over the past several decades, life expectancy has generally been inching up, but after COVID and with increase in overdose deaths nationally, the life expectancy actually leveled off or ticked down a bit. Did COVID affect the mortality charts as far as the longevity risk with retirement plans such as the companies?
It's still a work in progress. They didn't want to. The Society of Actuaries is the group that puts together the mortality tables, and they didn't want to overreact, and so they're still taking into the information and processing it. But the mortality table that you are currently using, it is based off of public sector data, and it came out in 2019. So
Okay, I was saying that doesn't count yet the 2020
it doesn't
death
take
rate.
into account the COVID information. So yes. So,
I'm satisfied. No, thank you for the good report and the explanations.
I always say I'm just dying to read those mortality.
well, better you than me then.
Actually, I hate to be worried that actually COVID reduced our longevity risk. So if anything, it benefits us down the road. Once the 2020 and 2021 death data is incorporated, the life expectancy is going to taper off just a hair. So our risk is less. So again, the pension fund is in good shape. So I hope to live long enough to draw from it someday, so continue to do a good job.
Are there any other questions for
No.
Mr. Riker?
Thank you for allowing
Thank you
me
so much.
and
Thank you.
have a
Yes.
great holidays, everybody.
Thank you,
Thank
sir.
you.
Well, thank you.
Safe
Safe
travels on the
travels to you,
turnpike.
yes.
Thank you.
Yes, you've got a nice day to drive, David.
Yes.
Thank
And you're, if you need to
Yes.
head out, we
Yeah,
understand.
I'll stay.
Okay, that's quite all right if we need to go. Thank you. And next on the agenda from Marquette Investment, we have our consultant, Sarah Wilson. And Sarah, we're always glad to see you, and especially if you're bringing us more good news.
Well, then I should probably get in the door because we know the third quarter was tough, but you hung in there on there. I just wanna, go through what we're gonna do. We're gonna talk about the market in the third quarter and how that affected performance. We are an extremely, volatile market right now. I'm sure you see every day, the market's up. It's had some good days to it. We're hoping that it'll finish up from this quarter in a positive way. But we're in double-digit returns. Not double-digit returns. Last year we came off of down double-digit returns. The year before we had these wonderful returns. And we knew that there was going to be a correction. And I think how you've diversified is really planned for that. So let's just go to Exhibit 2. And we'll talk about what's happened in the market environment. And it always changes so much. We look at what's happened in the quarter with real GDP. And then we looked at, it spiked year over year and then it started to come down GDP. We have this one word that we talk about. We'll talk a little bit about the Fed and what they've come out with inflation. But one of the things that we've noticed is on the bottom of page 10, you look at that total construction spending manufacturing, and we've really seen a bump. And that through August, for example, construction and manufacturing facilities were nearly 150% higher than 2 years ago. So we've looked at that, we've seen a bump, and that has helped with some of the returns for the market. But then we go and we talk about spending. Remember we talked about, this gets back to COVID. I just want one quarter not to talk about it, but it was really an interesting dynamic. So we look at spending and we look at what's happening with real household savings. And on page 11, we looked at, people saved during COVID. There wasn't really that much to spend it on, but there was a lot of savings. And now we start looking at real household savings are now starting to go down. And there's a couple things. We know that now their student loans are coming back into play. We're looking at a very tough economy. We talk about inflation, it's come down, but they're sitting there at that 2%. So what do they do to do the 2%? They raise those interest rates. We look at what's happening there and we look at the consumer. And if you really want to stand back and see what the consumer is doing, we've seen a ton of spending. We're starting to see unemployment starting to get a little bit soft. Job reports are starting to get a little bit soft. And the labor markets. And then we look at gasoline today. I think they said it was at $3.38, the average on the news. I don't think we've ever seen that in Pennsylvania, but because of all of that. But we've seen gas has really spiked. We have now seen that it's over $6 trillion with credit card debt, and 29%, 30% is now legal to charge on credit cards. So we're seeing the consumers starting to carry a lot more credit debt. And we talked last quarter, and we talked about mortgages, and the reason why after 2008 we saw that huge mortgage, defaults and everything. Well, that really hasn't happened because the average consumer is at 3%, 4%. They can afford their house payments. But then they went in and they refinanced or they took credit lines. Remember, credit lines are variable in a lot of cases. So you're going to start seeing that. And now they have just started to see that people are saying, do I pay my car? Do I go grocery shopping? Or do I pay the house payment? And we're now starting to see the consumer in there. While we expect good holiday spendings this quarter, because we're the land of debt, it's going to be probably next year where we're going to start seeing that come in. And we've now started seeing an increase in cars being repoed. So, you look across that where the consumer's trying to figure that out. So saving levels are gone. We talked about real estate. The average person now who's going out and buying a real estate, 7-8%. Some of us have seen that loan rate, that was the average loan rate. Problem is, you then have to put down 20%. Kids aren't, different generation, they also don't want to mow the lawn, so we've seen a huge uptick in rental properties. If you turn the page, and we just saw this, remember we're a global economy, that's page 12, we talk about global economy, and then I mentioned variable rate mortgages. We just thought that this was really interesting because of how low our interest rates were. Look at Australia, share of variable rates is at 80%. That is going to affect their economy. And then in turn, that's going to affect where we see that. Further, the typical term length for mortgages outside the US ranges from 2 to 10 years, which generates a higher frequency of refinancing. Ours, we're now more on 30%. So when we talk about what happened, on page 13, we talk about the US equity, and we know that we were down a quarter. We look at US equities outperformed the international developed counterparts, but slightly lagged emerging markets. US dollar strength played a key role during the third quarter. When we look at that, we look though, from 9:30 to 9:30, I think this is really interesting. Look how much the market grew from that time span. So while we were down 3.3, if we went back from 9:30 last year to 9:30, the US equities were up 20.5%, but we still had a double-digit down return because that fourth quarter had really bounced us back. And we had seen a lot of that growth, but it was there. So we look at high yield bonds were down. We look at US bonds are down yet again. And that's been a very good thing on diversifying, as you know, because fixed income's in negative territory once again there. If you turn the page, we look at sector returns, and we saw that economic sector performance was mostly negative in the third quarter, but most defensive sectors lagged the broad markets. We look at sectors such as consumer staples and utilities were pressured by higher rates. And then what we also talk about is we've had, we're now the Super 7. We've talked a little bit about that this year, 7 stocks moving the market. We've seen that 5 stocks move the market in March during COVID. We see that now, the 7 stocks. So what's happened was value benefited from outperformance of energy and financials, but value has yet again underperformed consistently quarter to quarter growth. We still like a very small value tilt. You'll see in your performance for the quarter, it protects you on the downside. You don't need as much protection on the upside. You want more protection on the downside. There, we look year to date, however, large cap and growth stocks have dramatically outperformed the broad market. When we talk about the U.S. Stocks, we look at what's happened with the U.S. stocks since 1971. History shows the equity market outcome are radically different depending on the latter question. What that question is, whether the federal rate is doing to raise short-term rates. So when we look at the bottom of page 15, we talk about this. We know the Fed came out and they said we're not raising rates. They kept them again, second time running. Market like that. They expected that. We know that we believe the market has said, they've gone up too fast, they went down too fast, they went up too fast. One thing that has really come out with the Fed, when you look at what they're saying, is that the market, when you look at market commentary, is they're saying that they're really not looking as forward as they should. So, they keep getting these inflation numbers. Okay, well, it's a little bit above 2%, gotta get lower, gotta lower it, and spike, raise interest rates. But it takes 6 to 9 months for that to come into effect to the American consumer. So great, it goes up a quarter, you're still paying $4 a gallon for gas. You might then end up paying $4.75. The credit cards have now gone up. 12 months later, you're having that issue. So they're saying, when the market looks at what the Fed is, they're saying, you need to kind of be more forward-looking when you make those rate changes. We talked about when we look at the election. Next year, we're going into the election. I think there's 2 things to note about the election. In the third year of the election, when we look at an election cycle, this is the year that we're kind of calm, and this is where you're going to get your growth. And then the fourth year is going to be kind of stable. and you usually look at being somewhat positive in that presidential election. You've got a couple of factors that we now have. We have the issue with Israel, Syria. Ukraine has not changed, we kind of thought that would not go on as long as it wants. Israel's gonna come into play a lot, so we have that. We also have a very different kind of presidential election going in next year. So the volatility of the market could be just reacting to that, but it's probably not gonna be historically in the last 20, 25 years, we're able to say fourth quarter's nice, third year is kind of, where it's gonna be, then the fourth year of the presidential election, we're not gonna see that much volatility. I think we could see some volatility, a lot more volatility going into next year when we look at that. Are there any questions on that? All right, let's talk a little bit about what you did. We'll go to page 22. So at the end of September, you're 89.9 million. You returned a negative 2.5% versus the relative benchmark of 2
Sorry, what
million.
page you on?
Page 22, next, exhibit 3. I still call them tabs. Year to date, you had a return of 5.2 with a net investment gain of 4.5 million. Remember I said it's probably gonna be a tough year, this year. For the trailing 3 years, and I think this is interesting because this includes a lot of the volatility, you still had an annualized return of 5.2 with a net investment gain of 9.3. Since inception, you have met your actuarial return, you've annualized 6.1, had a net investment gain of $47.2 million. We're gonna look at your managers. You had outperformance from infrastructure, Eaton Vance, Dodge, and Cox. You had outperformance from fixed income manager CS McKee. Remember, we switched over to them. We readjusted how your portfolio was, and I think that has paid off for you. And then we have our underperformance by your equity managers, Artisan and Hardin and Lover. Artisan's interesting. Artisan has got where they are in their space. They've caught up a little bit with their performance, but when we looked at it last quarter, you'd be like, how on earth can you keep them in there? Well, according to their peers, they're on the top of their peer group. It's just been a very hard space that they're in. They have done very well long-term. We had them in, we had the portfolio team in, all of us consultants were on that call or, meeting with them in person. Because, it gets hard to come out and say, remember, we had Wellington, we didn't like them, they had a portfolio change, and we got rid of them and put you in an index immediately. And that happened in the course of 3 weeks when we saw it change. We are very comfortable with Artisan. We monitor them. They have had no changes in portfolio management. They're just where they are benchmarking against to. They've still done well. It's just what they're benchmarking against to and what their peers are doing, they look really off. So we'll delve into that there. And then looking ahead, I'll probably come out and like to come out and do either an education with the board, or we can do the January meeting, the Pennsylvania County database report, and then also with new board members, we'll do the new fiduciary board kit to do that. So that would be in January. All right, let's go to page 30. And that's where you're gonna see your performance there. And we look at US equity composites. Eaton Vance has done very well for you. You can see for the quarter they were down 2.1 versus the benchmark of 4.8. They were a little off year to date. Small cap has been a really hard space to be in, but year to date they're up 14.8% versus 11.8. So they've done very well for you. We put them in since we took over in February 2014. They've annualized 11% versus 7% of the market. We look at your global equity composite, has done well for you there. Dodge and Cox is one of those ones that they will do very well in, some quarters. Some quarters they won't do as well. They're kind of your alpha, so they've got a little bit of more volatility. But we really like them. I mean, you can see since we've put them in August 2021, They're positive 2.3 versus their benchmark of a negative 1.2. And they were 11.6 over the benchmark of 2.4. They were also positive in 3 months. We really like them as a manager. They're not always gonna look like that. There'll be some quarters where you stand back and think, oh my, but they have done very consistently well. Artisan, that's what I just talked about. You can see that they just had a very tough year to date. They were 9% versus 18.2. That is really where they kind of went away from where they were going, but you can see that we've managed for the quarter, negative 5.6 versus 4.9. We are not concerned. I mean, we did have them in. We've got, just so you know, we have about 35 performance analysts, and we have our research analysts, and we've got our client analysts, we've got the USCIO team. We also meet research meets once a week on each level class. So, I mean, they're very monitored. We would get rid of them. We have no ties to any manager. We just believe that when we look at them long term, they have done very well for us. They're just in that space right now. You look at total non-US equities, and we always see that there. Harding and Lover just had a tough time, but for the last, and that's below under non-US equity composite, page 31, but they've averaged in the last year 14% versus 15.7. They've done well. They are just off, and it's just US small cap growth. Yet again, it's a hard place to be there. When we look at your real estate composite, real estate has come back for you in this quarter. So what happened in real estate was wonderful last year. When markets were double digit, real estate was positive. So every manager went, as we did, and said, we're redeeming, we're taking some of that money off the top. What we did do too, is we changed you from reinvesting into taking the dividends out to meet your cash needs. And we did that across the board with all of our clients. So they had this run on everybody taking out money. It didn't really affect them as much, but what we did was for all of our new clients, we've actually held off putting into real estate. We're just slowly starting to get back in there. They had a real shift. They were down negative for the quarter, 1.5 versus 2.2, but I think this is where they are. They averaged 5.6 annualized from March 16th. That's exactly what we said, 5 to 7% with real estate. If we go look at that number with fixed income, you're gonna see about 1%. So that's where you funded it from. And so real estate has benefited you in some years, and we were able to redeem a little bit. We were able to also take a lot of that cash out to help you with your cash needs throughout the course there. Let's turn the page to page 32. You can see that since you have put in JP Morgan, your infrastructure, they've annualized 9.9 versus 7.5. Year to date, they're at 6.9 trillion. 1 year, they're 10%. That has been a very nice thing for you as we see infrastructure doing well. Defensive equity has also done well for you. You did that in August 2021. So all these diversifications have really helped this portfolio. If you were just in fixed income and equities, you would not have those returns that you see. And you can see that for the trailing 1 year, they've done 17.4, 13.1. And then we go look at US fixed income. We look at US fixed income for the last 9 years since we've been here, it has annualized 0.7%. Remember, you were probably about 55, equity 6%, 35% fixed income. So we've really taken that down, which has done well for you. Having C.S. McKee has done very well for you there. And then what we did was we did the US bond fixed income. So you've done, but fixed income year to date, the market's down negative 1.2, you're only down 0.9. So, I mean, you have to have fixed income as a pension fund, but it's a really hard place to be. And that's why all that diversification has really helped you. And you're also in with all that diversification, you have very low fees, 31 basis points. Are there any questions?
Start with Commissioner Burek to see if he has any questions for Sarah.
No questions. My biggest concern going forward is the the federal debt, despite what the Federal Reserve's been doing, raising interest rates with what the federal government's been spending, that's going to continue to promote higher than expected inflation. And I think that's weighing negatively on the markets, in my estimation. But no questions on the report. Thank you.
Thank you. Treasurer Rapone,
No, thank you, sir. No questions?
Controller Prestipon,
No, I'm good.
Commissioner Spielvogel.
Same here. Thank you.
Well, I want to say, as I know, it's been a pleasure to work with you, Rev, for the last 4 years. I really enjoyed it. Thank you for all your support, and it's been a pleasure to work with you this year. I wish you the best of luck. And I look forward to seeing everybody at CCAP as well in January, and I'll get a date on the books for that and how we want to do that. But I've really enjoyed working with this board, and again, thank you so much.
Thank you.
And have a happy Thanksgiving.
Yes.
Happy Thanksgiving.
Thank you, Sarah. Same to you and your family. If you folks need to move along, we understand. We have a couple of items we have to take action on. You're very welcome to stay, but like I said, if you have, I know you both have to travel, so.
Not bad today.
Thank you again. Under new business, before we get to these, David, you can help me. I recall in some years, we've had to have a special meeting in December to wrap up some year-end things. Are we doing that today, or do you think we may have to reconvene?
I think we got everything.
Okay. And obviously, if something comes up, we can always have a special meeting, but, well, thank you. And that being said, the first item is a proposed resolution. And Vanessa, do you happen to know the number?
2.
2, okay, thank you. This proposed resolution deals with the contract that we have with Korn Ferry for their actuarial services. For the calendar year, or for taking effect on January 1 of 2024, Korn Ferry has indicated that they are proposing a 1% increase in the fee that they charge us for their services. And this resolution would approve that request that they have made to us. Let me see if there's a motion, and then I can open it up for discussion.
I'll make the motion.
Thank you, David. Is there a second?
I will second.
Thank you, Loretta. Comments or questions from anyone on the board? Okay, thank you. That being said, I'll ask Vanessa to call the roll.
Controller Prestipine,
Yes.
Treasurer Rapone,
Yes.
Commissioner Spielvogel,
Yes.
Commissioner Buick,
Yes.
Commissioner Vogler.
Yes,
Motion carries.
thank you. Next would be proposed resolution 3 for the retirement board. We're to undertake a discussion and possible approval for the rate of interest to be credited into member accounts for the fiscal year 2024. This action then would take effect on January 1 of 2024. I'm going to refer to our controller. I believe you have the knowledge and background that you can share with us on this.
Currently, our rate is set at 4.25%, so 4.25%. Based on, we got a estimate of our ADC that we're going to owe in 2024, and it's an increase of almost a little less than $400,000. So my recommendation would be to keep it at the 4.25% rather than do anything to raise that any higher than it already is.
You've heard the controller's recommendation. Are there questions or concerns from any of the members of the board? Thank you. Brian? Okay. Thank you. This is proposed resolution 3. Now that we've had the background and discussion, I could open it up for a motion for approval of this resolution.
I'll make the motion.
Thank you, David. Is there a second?
So moved.
Rich, thank you very kindly. Any further comments or questions? We'll take a roll call, please.
Controller Prestipine,
Yes.
Treasurer Rapone,
Yes.
Commissioner Spielvogel,
Yes.
Commissioner Buick,
Yes.
Commissioner Vogler.
Yes.
Motion carries.
Thank you, Vanessa.
Mhm.
We have no resolutions on the table. Things, I'll open it for public comments. Debbie, you are the public today.
Comments or questions?
No comments or questions? Okay, thank you. And I'll give you my packet like I usually do, although you do have both of these documents,
I
right?
do, thank you.
Okay, good. Before we adjourn, let me just move around the table to see if there are any other comments or concerns. I'll start with Commissioner Burek.
None, thank you.
Thank you, sir. Treasurer Rapone?
Yes, I do. I want to say, at the end of the year, there's some slight changes, and I just want to say, what a joy and honor it was to work with you, Loretta. It really was. Very intelligent person, but also somebody you can have a lot of fun with. So you may come into work joyful, and I think anytime we can work hard and we can play hard in our environment, that's quite the blessing. I know how much you loved doing what you did. And I truly believe that God has something very special in store for you. Nonetheless, it's goodbyes are hard, I hate goodbyes. So I must say so long to a dear friend and comrade. It was an honor to serve on this board and serve at the county with you the past 4 years, my friend. Brian, it's also, I've known you for a long time, and you brought so much to the board with your appointments. You know, you're such an intelligent individual and your passion for service. And it's been an honor working with you as well. The county was better because of your service. And once again, I hate goodbyes, but so long. And I know that God has something very special in store for you as well. I think both of you are not done, you know, contributing to the better good, you know, of our county. So with that,
Thank you, sir.
Thank you very much.
Controller Crestopine, any closing remarks?
Now, what Richard said, I want to thank Loretta and Brian. It's been a pleasure serving with you here. I've been a controller for a couple of years here, but it's been a pleasure working with both of you throughout the year.
Thank you, sir. Commissioner Spilbo.
I want to say thank you, Sarah. It has been a pleasure working and playing. And see you at CCAP and continue that. You've done, Marquette has done very well for the county, just knowing that it was a learning experience for me and I enjoyed every meeting that we had. A pleasure meeting you for the first time, and I know that, again, that we're in very good hands, and whatever the future holds, it holds. It has been a pleasure working with all of you. Without a doubt, we get the work done, and we can laugh and joke and have a good time with it too. But the work always gets done, and that's one thing that I can say, even, you know, moving forward with the new members of the board, that it will continue. It will continue because of course with people that are here, we'll make sure that it does. So thank you.
Mr. Chairman, can I have a second chance?
Of course you may.
First, my colleagues didn't realize this will be my last public meeting with the entire retirement board. I just want to say thank you for your kind words. I want to congratulate Dave, Richard, and Dan on their reelection. When I was on the retirement board the first time, we actually had all 5 members were brand new. When I took office in January of 1996, all 3 commissioners were new, the treasurer was new, the controller was new. And so we went through a learning curve, but there's great benefit to the county that 3 of the 5 retirement board members
Yes.
will remain on. So I congratulate you. I thank you for the excellent job you've done as fiduciaries of the county pension fund, and I wish you well. Thank you.
Thank you so much. We will miss both of you in terms of your service on this board. And I echo my colleagues' comments for thanking both of you for your diligence and your attention to the detail that goes into this. And we, as Rich said, we wish you both nothing but the very best as you move forward. Our thanks to our friends who advise us. We appreciate your joining us. Vanessa, anything that you're aware of that we've overlooked? Thank you. Well, that all being said, and Debbie, you're up to speed? Okay. That all being said, may I please have a motion to adjourn this meeting?
So moved.
Second.
All those in favor, please say aye.
Aye.
Opposed, same sign, motion carries. The meeting is adjourned and Bill's gonna come in and turn off the
Shut it down.
computer. Thank you, everybody. David, it's a pleasure.
Yeah.
Me as a CCAP